Cryptocurrency Technicals module. Although cryptocurrencies are a very new and exciting area to explore, we still have to realize that at the end of the day, what we're dealing with is a market. Again, if you remember from Trading 100, a market is a place where buyers and sellers come to the table to facilitate trades. Buyers offer bids at a price point that they see value. Sellers ask for what they think is a fair price. Eventually, they settle upon a transactional amount. Trading dichotomy. We recall again from the Technicals 100 module that we have fundamental and technical traders. Fundamental traders base decisions on macroeconomic data, industry conditions, financial conditions, and of course, management of companies in the case of stocks. Technical traders look at historical prices, historical volume, and metrics on the above. So if we remember, what is technical analysis? Technical analysis is any technique used to evaluate the security in an attempt to forecast future movement based on historical statistics. What do we mean by historical statistics? We can look at price data, volume data, number of orders placed, and other metrics. This is nothing new from Technicals 100. However, it's important to stress that the same types of things that we take into account when we trade futures or things that we know are the same types of things that we'll take into account when we trade this new product. Introduction. So we'll take a look at candlestick charts, review levels, take a look at Fibonacci levels, candlestick patterns, and Elliott wave, and apply those to cryptocurrencies. Price visualization, candlesticks. This is just a summary of the price data in a particular interval. It forms the basis of most technical analysis. Anatomy of a candlestick, we have the body formed by the open and the close, and the low and high form the wicks. We call them candlesticks because they appear as such given the wick. A bearish candle is the same thing, but where the close, or where we ended, is much lower than the open. Here we have an example of a candlestick pattern with the price of Ripple against the USD. Volatility. We recall that volatility is a spread in price over a given time period. It can be measured by the standard deviation in price or a variety of other metrics, such as the ATR. Again, we recall liquidity is the ability to easily buy or sell an asset. In liquid markets, we have a very high probability of getting filled. We have very little slippage, or if I enter at a market order, I expect to be filled somewhat near the market price. And the fact that our trade won't affect the overall price of the asset. Levels. Levels are characterized by high liquidity and a narrow range. We remember from Technicals 100 that the more throughput we have at a certain level, we have a concentration of liquidity at that level and a draw from the upper and lower boundaries. These form vacuum zones. Levels indicate support and resistance. A level at a reversal at a level can indicate a change of trend. However, breaking through a level can indicate a confirmation of a trend. The longer the time duration of that level equals the strength of the level. Examples of levels. We can take a look at highs and lows, yesterday's closing price, where the heads and the tails of the candles align, points of control, gaps, or Fibonacci levels. Fibonacci levels. Recall that Fibonacci levels are just ratios of Fibonacci numbers. These represent steps that are significant in some way. These remain meaningful even when nested. For example, we see this picture of the human arm divided up into sections, and the ratios are the same here as they are for the digits of the fingers, and these are nested within each other. These form very useful levels in trading, just like we saw with futures and stocks, same with cryptocurrencies. They are both an art and a science to construct. Fibonacci retracements and extensions can identify key levels. Cryptocurrencies are very, very obedient to the Fibonaccis. Cryptocurrencies are also extraordinarily technically traded, much more so than other markets. So first, we want to identify key levels. We take significant points or anchor points, and using those anchor points, we can determine retracements, or the levels between the anchor points, or extensions, the levels past the anchor points. Levels are based on ratios between Fibonacci numbers. Fibonacci retracements can identify key levels between anchor points. If the asset retraces, these provide resistance. Fibonacci extensions can look past the anchor points and project where we might go if we see a breakout. For example, consider Bitcoin. If we anchor at the top here and down below at 1800, we have very strict adherence to these Fibonacci retracements. Part 2, indicators. Here we review some general concepts and really discuss in detail moving averages and their application to cryptocurrencies. In particular, the simple moving average and the exponential moving average. What is an indicator? It's a device for providing specific information on the state or condition of something. Indicators in trading. These are numeric measurements on the state of the asset. They can tell us trend, volume, volatility, liquidity, and sentiment. But we will focus on trend, volume, and volatility for the purposes of this module. Be careful because indicators work best when combined with other macro data, intermarket correlation, or other underlying factor. Most indicators are just fancy moving averages. So for moving averages, we have the average price in a given period. These can measure trend, support, and resistance. And the period size is what we call a sliding window because as the chart updates, we have to update our measurement. The slope upward is considered bullish, downward is considered bearish. A larger window size accounts for more data. This was slow to change, so not so volatile, and can be a good measurement or a benchmark for long-term support and resistance. Typical window sizes are 50, 100, and 200. For example, if we take a look at the chart for Litecoin, we see how the faster moving average keeps up with the asset price a lot more so than the slower moving average, which changes gradually. However, slower moving average can be a very good measure of support and resistance. It's not a coincidence that this candlestick was unable to break through this support. Oftentimes, moving averages will be discussed in the news. For example, if Bitcoin breaks above the 50-day moving average, as discussed here from this article in CoinDesk, that's considered a bullish signal. Common moving averages. You can look at the simple moving average, where all candlesticks are weighted equally, the exponential moving average, where more recent candles are given more precedence, and the exponential moving average is a special case of the weighted moving average, in which we do not consider each candlestick to be equal. Here we review some chart patterns that show up time and again when trading cryptocurrencies technically. In particular, the head and shoulders pattern and the dragon head formation. The head and shoulders, we have failure to make new highs. We want to focus on the neckline. Stop loss can be at the previous bar for low risk, significant levels, medium risk, Fibonacci levels, also medium risk, or last shoulder, which is a higher risk. So if we recall, this is what the head and shoulders looks like. Next, we'll take a look at that dragon head pattern before reviewing some practical examples with actual cryptocurrency charts. I also call this the rising dragon pattern, and it's similar to the teacup and handle, except we recall that there's 4 stages. 1, exponential growth, 2, a sharp retracement, 3, volatility, and 4, consolidation. A breakout can be expected after stage 4, if momentum continues. This is a diagram of the dragon head formation. We have phase 1, exponential growth, followed by a sharp retracement in phase 2. Phase 3 gives us volatility as the market tries to find footing. Phase 4 is consolidation. A breakout, you say? Well, a breakout is often to the upside if momentum is still positive. However, it could continue to retrace if investors lose interest. It's important to emphasize that the dragon head breakout pattern is very common and working really well for cryptocurrencies at the moment. For example, we have phase 1, exponential growth in Ethereum, followed by a rapid decline. We have volatility here in the candlesticks, represented as long wicks, followed by phase 4, a consolidation at a level. Next, we have a breakout on the upside. Adding indicators. Adding indicators helps strengthen your confidence in taking a trade. Bollinger Bands in particular can help you identify high volatility and a strong trend. Of course, you want to combine these with candlestick patterns, which will help you determine when the phases of the dragon head pattern might occur. Candlestick patterns. These are specific configurations of candles. These could confirm a level rejection. They're most reliable when paired with other technical or fundamental data and over longer time frames. So in other words, when I see a candlestick pattern on the day candles, that candlestick pattern is a little bit more probable than what I might expect at the 1 minute granularity. I've provided a summary of candlestick patterns here. For a more detailed explanation, please see the Technicals 100 module. Examples. Candlestick patterns are best when paired with an indicator. And in this case, we're using Bollinger Bands. So if you notice, going back to these phases of the dragon head pattern in Ethereum, we have this red triangle indicating when those periods of retracement might occur. Zooming in, we see that these patterns are nested. Adding indicators. We want to use Fibonacci levels and extensions. This helps us determine when the phases might occur. For example, returning to Ethereum, if I anchor my Fibonaccis at the high and the low here, I can anticipate where this asset may drop and where I might see a rejection. That is, when the bulls may come back to life. Anchoring Fibonacci levels. We want to pay attention to highs and lows and the heads and tails of the candle, and these must agree with previous levels. It's a very good indicator of future levels. Fibonaccis are incredibly predictive as an indicator. For example, if I anchor Ripple here and at the lower bound here, it is no surprise that my asset reaches the Fibonacci extension. That can be placed as a profit target or my expectation of where this asset might go. Recall that my Fibonacci retracements can be anchored at either the heads or the tails or the highs and the lows. In the previous slide, we saw the predictive capabilities when I chose to anchor at the heads and the tails. Notice how the extension doesn't really align with where the asset went. However, if you play around with it and instead anchor at the high, you see a much better representation. Adding indicators. So in other words, we want to keep stacking technical analysis to try to confirm or deny the probability of success. Another tool we can use is Elliott wave theory. Elliott wave theory can be used to identify trends and reversals, where they happen, and why. So we recall that markets tend to move in impulses into the trend and corrections away from the trend. These are fractal in nature. Our notation allows for 9 different nested levels of fractal behavior. In reality, we only use 2 or 3. The basis of Elliott wave analysis is the 5-3 wave. In other words, impulses that occur in 5 segments or waves, and corrections which occur in 3 waves. The above, again, is an example of a 5-3 wave. These are fairly reliable on any chart pattern regardless of time period. So they're just as reliable on the 1 minute as they are on the day. The subjective nature of this form of analysis might make it difficult for beginners or even experts. In fact, 2 Elliott wave practitioners will generally not draw the same waves, however, hopefully they come to the same conclusions. Elliott waves are nested or fractal in nature, and these patterns tend to repeat as you zoom in. So here's an example of a 5-3 wave. As we zoom in, we see the nestedness of 5-3 waves in each impulse. And zoom in once more, and we see more fractal nature. The rules of drawing the Elliott wave. Wave 1 starts the trend. This could possibly be a correction from before. Wave 3 is the longest and strongest. It can't be the shortest. Subsequent waves may not dip lower or higher than the previous, and subsequent waves may not extend higher or lower than the previous. Let's combine everything together. Right? So we have our Bollinger Bands, we have candlestick patterns, we have Fibonacci levels, and we have Elliott wave. So let's not only take a look at these cryptocurrencies, but anticipated price action. Let's take a look at Bitcoin. Bitcoin is highly technically traded. It respects Fibonacci retracements for pullbacks, and also respects Fibonacci extensions for profit targets. Elliott wave is very clear, and it's easy to spot the nested nature. For example, we can take a look at this overall chart. We see the 5-3 wave presented here, followed by a subsequent 5-3 wave. If we zoom in, we see another 5-period impulse wave within wave 1. Here we zoom in on the first 5-3 wave. Here we zoom in on the second. Observe how Bitcoin obeys the Fibonacci retracement levels. Here I can use Elliott wave combined with Fibonacci levels to determine where this asset might go in the future. Let's take a look at Ethereum. Ethereum also respects Fibonacci retracements and extensions. However, the Elliott wave was broken in September of 2017, and we'll discuss why. So here we take a look at what originally was thought to be the Elliott wave with the retracement here. This is shown in black. However, we failed to break this high shown at 5 in black. This means we have to start over or redo our analysis entirely. So here I've started over drawing the Elliott wave, and we have our retracement here, and here is where we can expect Ethereum to go if it still obeys Elliott wave. Note again how Ethereum respects the Fibonacci retracement levels. Litecoin is somewhat stubborn with Fibonacci levels. However, we want to observe that the Elliott wave is unbroken when compared with Ethereum. Here's the chart of Litecoin shown with Elliott wave, Bollinger Bands, Fibonacci retracement levels. Notice we have our 5-3 wave here, followed by a retracement, followed by another impulse, and it looks like we're ready for wave 3, or the strongest impulse. Altcoins. With altcoins we have mixed results. This is a function of the age of the coin, volatility, and investor interest. If there's not a lot of interest in the coin, we can expect low liquidity. And we know that when we have low liquidity, we have a lot of volatility and a lot of erraticness in the price. For example, consider the chart for NEO. Again, notice how it respects the Fibonacci levels. Secondly, we can consider a chart for Ripple. Ripple's been a little bit more finicky with the Fibonacci levels. It's been a little hard to center it, but I think I've done a pretty good job here. This has been the Cryptocurrency Technicals module. Thanks for tuning in.